Hello, friends of Top 10 Den. Today we're venturing into the world of high finance. Buckle up, because we're going to delve into a topic that might seem complex, but is essential to understand the inner workings of our economy. The perils of central banking. Grab your ledgers and tighten your bow ties, because we're about to crunch some serious numbers. The first major concern about central banking systems is the accumulation of immense power in one institution. The Federal Reserve, for example, influences monetary policy for the entire United States. Now, putting all your eggs in one basket is risky even when you're going on a picnic, let alone when you're managing a nation's wealth. Secondly, transparency can be a serious issue. Central banks are famously cryptic institutions, sometimes more elusive than Bigfoot playing hide-and-seek. Their decision-making processes and the factors they consider can often be shrouded in secrecy, leaving us mere mortals wondering what magic spells they're casting over our economy. Number 3 on our list is the control of inflation. Central banks have the power to manipulate interest rates and influence the money supply. Sounds great, right? But what happens when the printing press starts moving faster than Usain Bolt on roller skates? Well, that's how you end up with a wheelbarrow full of cash to buy a loaf of bread. Moving on to number 4, we have the risk of monetary policy mistakes. Even the grand wizards of central banking can get it wrong. And when they do, the effects ripple through the economy, sometimes leading to financial crises that make your bank account look emptier than a politician's promises. At the halfway mark, we have the potential for political influence. Central banks are supposed to be independent, but let's be real, politicians often find a way to sneak their fingers into the pie, and when that happens, monetary policy can become a tool for political ends rather than for economic stability. Number 6 is the role of the central bank as the lender of last resort. This might sound like a superhero power, but it can lead to moral hazard. If financial institutions know they can be reckless and get bailed out, they might start playing fast and loose with your hard-earned money. Next up, we have the creation of asset bubbles. When central banks keep interest rates low for too long, it's like an open bar at a wedding. Things can get out of hand real fast. Easy money can inflate asset prices to levels that Wile E. Coyote wouldn't dare to climb, leading to nasty crashes when the bubble bursts. At number 8, we have the role of central banking in income inequality. Central banks can indirectly boost the stock market through their policies. That's great if you're Scrooge McDuck, but not so much for the average Joe who doesn't have a significant portion of his wealth tied up in stocks. Number 9 on our list is how central banks can encourage high levels of public debt. By buying government bonds, central banks can make it easier for governments to spend money like a drunken sailor on payday. But remember, what the government gives with one hand, it must take back with the other, usually through taxes or, you guessed it, more debt. Finally, we have the zero-sum game of currency manipulation. When central banks manipulate their own currencies to gain an edge in global trade, it can lead to currency wars. Just like in a real war, there are no true winners in a currency war, only different degrees of losers. And that's a wrap, folks. Central banks might be a necessary evil in our complex economies, but that doesn't mean we should turn a blind eye to their potential downsides. Now, if this video caused a surge in your knowledge economy, be sure to hit that like button. Comment down below on what topic you want us to tackle next, and subscribe to Top 10 Den for more enlightening Top 10 lists. Until then, keep questioning, keep learning, and remember, the bank might not always be on your side.